Alright, for this video I want to go through a sample form 8606 for non-deductible traditional IRA contributions. So we've got the 8606 here. We'll go through this in its entirety. It's also part of a full Form 1040, so we'll go through the Form 1040, all of the schedules, the 8606, and all the worksheets. But before we get into this, let's just go through some background on the basics of traditional IRAs and some more details on the fact patterns. So when we talk about IRAs, there's really two types. There's the traditional IRA or the Roth IRA. When you make a contribution to a traditional IRA, you generally get a tax deduction for the amount of money you put into the account. In contrast, when you make contributions to Roths, those are not tax deductible. Okay? Now, as far as when you can make these contributions, it can certainly be made anytime during the calendar year. So if we're looking at a 2024 tax year, you can make them during 2024, or you can make them in 2025, so long as they're on or before the filing deadline of April 15th. Now, you can still file extensions to move your Form 1040 deadline, but the contribution itself still has to be in before this April 15th deadline. You don't get an extension to make that traditional IRA contribution and have it apply to the prior period. Now, as far as the limits for 2024, it's $7,000 across all IRAs for single filers. If you're age 50 or older, you can contribute up to $8,000. So there's a $1,000 catch-up if you're 50 or older. Now, the amount that you can deduct, if your income is below a certain threshold, you can generally write off the full $7,000. However, if you're covered by a retirement plan at work and your income falls within certain ranges, the deduction amount is going to be limited. Okay? Now, if you make a traditional IRA contribution, you do the worksheets, and you find you didn't get a full tax deduction, you must be completing the Form 8606, which is what we're going to go through with this tutorial. And the 8606 is really important because it tracks your basis in that traditional IRA. All right. Now, the IRS website does have some great resources on how these work and what the limits are. I'll put links below in the description to all these pages so you can go reference them as well. But we can see here that the IRA contribution limits, they've updated this for 2024. Again, it's $7,000, $8K if you're 50 or older. The IRA deduction limits page, this highlights how Roth IRA contributions are not tax deductible. And then traditional IRAs, the deduction is limited depending on your income and whether you're covered by a retirement plan at work or you have no retirement plan at your place of employment. Now, as far as the ranges income-wise, this table does a really good job at summarizing it. So if your filing status is single or head of household, and this is for if you're covered by a retirement plan at work, if your income, your modified AGI is $77,000 or less, you get a full deduction for whatever you contributed. If you're between $77,000 and $87,000, you get a partial deduction. There's a phase out, and that's what we'll look at with the calculation. And then if your income, your modified AGI is $87,000 or more under these filing statuses, you get no deduction. All right, and so this is what we're going to see play out with this example. So in this fact pattern, we have during 2024, Jane made a $7,000 contribution to her traditional IRA. Now, she's also covered by a retirement plan at work. She just wanted to put some additional money away for retirement. Her W-2 shows that she had wages, so this is box 1, wages of $80,000, and she had a 401k contribution of $5K. Now, this is Jane's first IRA. She doesn't have any previous contributions to either a traditional or a Roth, and so she calculates the amount of her deduction and reports all of this on a Form 8606. So if we have a look at page 1 of her 1040, her return is pretty straightforward, right? We can see the wages in box 1A. She has some investment income down here of $5, so her AGI is $80,005. So the 8606, before you complete this, you want to complete the worksheets to figure out whether or not any of it is non-deductible. So if we start with the IRA deduction worksheet, there's separate columns for yourself as the taxpayer and then your spouse, because you have to do this for both if you're doing a married filing joint return. So question 1A, were you covered by a retirement plan at work? And for us, it's yes. So we've indicated yes in the Your IRA column. Now, as it highlights here in question 1B, if you check no on either of these lines, you would skip lines 2 through 6, and then you would enter the applicable amount here on line 7A, so either 7K if under 50 or 8K if 50 or older. In our case, we've indicated yes, so we've got to do these additional line items. So line 2, we're entering the applicable amount here depending on our filing status. So for single, head of household, married filing separately, you would enter $87,000. So on line 2A, Jane has entered $87,000. Line 3, this is our adjusted gross income. So line 9 from page 1 of that 1040 was $80,005. Now Schedule 1 has some additional income or adjustments to income. If you have any that fall within these lines, you would report that total here. If we take a quick look at her Schedule 1, you'll notice here that in Part 1 we don't have any additional income items. In Part 2, for adjustments, we don't have any adjustments other than the traditional IRA deduction, which we're going to compute in a bit here. So when doing this worksheet for Jane, question 4 is just 0. So line item 5A, we subtract line 4 from line 3. So 0 from line 3 just leaves us with the same number, $80,005. Now, on to some more questions, right? So is the amount on line 5 less than the amount on line 2? In our case, the answer is yes, right? So what they're testing there is, well, if our income exceeded this $87,000 threshold, remember on the IRS website table, we get no deduction, right? So we would stop there. None of our IRA contributions are going to be tax deductible. So we are under that threshold, so we can keep moving forward. Now 6, we've answered yes. We would subtract line 5 from line 2 and enter the difference. So we subtract these two figures and we're left with $6,995. Now if you're single, head of household, or married filing separately and the result is $10,000 or more, enter the applicable amount below on line 7. So this number is less, so we can put this number. If the number was greater, if it was greater than 10,000, we would enter either 7K or 8K, again, depending on our age. But for us, the amount is under 10,000, so we just leave the 6,995 figure. Moving on to page 2. Now in question 7, it asks us multiply line 6A and B by the percentage below that applies to us. If the result isn't a multiple of 10, increase to the next multiple of 10. So we would round up. So if you find that you're within, if it's not multiples of 10 or it's you have some cents there, like they do in this example, you would round up to the nearest $10. So for us, single head of household, married filing separate, we would multiply 70% by the amount listed above. So we would look at our 6,995 figure, multiply that by 70%, and we're left with $4,900. Now moving on to line 8, enter the total wages, salaries, tips, etc. Also report any kind of alimony or separate payments. In our case, our wages, box 1 wages, are just $80,000. So notice that doesn't include other things like investment income. It's just our earned income or earned compensation. Moving on to line 9, enter any other earned income that you would receive as a self-employed individual or partner. So if you have a Schedule C and you're completing Schedule SE for self-employed individuals, you would report that amount of income. If you're a partner in a partnership and you actively participate in that partnership, your allocation of earnings generally subject to self-employment tax. In this case, we've left 9-0 because none of that applies to Jane. So we're left with $80,000 on line 10. Now on line 11, it asks us enter our traditional IRA contributions made or ones that will be made by the due date of the return. In our case, she's already put in the full $7,000 during 2024, so we can't put in any more money in. We won't be making any more contributions leading up to April 15th, 2025. Then on line 12, asks us enter the smallest figure of line 7A, 10, or 11A. Well, 11A is 7,000, line 10, 80,000, and then line 7A, $4,900. Okay, so in our case, the smallest figure between this, that, and then this figure up here is going to be the line 7A amount for $4,900. So on line 12A, we've listed $4,900. This is the deductible portion of our $7,000 contribution. So the $4,900, if we go back to Schedule 1, where we enter our adjustments in Part 2, we can see here on line 20, we've entered an IRA deduction of $4,900. And so if we go back to page 1, we can see that the $4,900 is reported here. So this is our reduction to income. We had $80,005. We've reduced it by $4,900. So now our adjusted gross income from the total is $75,105. And then you can move on from there. Standard deduction or itemized deductions, and then calculate the appropriate amount of tax on your taxable income. So the $7,000 she put in is fine. That's under the limit. She's allowed to do that, but she's not going to get to deduct the full $7,000. She's only deducting $4,900. So now that you've figured out that you have a non-deductible portion, you need to include the 8606. So the non-deductible portion is reported up here on line 1. Enter the total non-deductible contributions to traditional IRAs on line 1, and it's $2,100. How do we get that figure? Well, we have $7,000 minus the deductible portion, meaning the difference there is going to be the non-deductible portion of $2,100. So on Jane's 8606, she's got $2,100. Her basis in traditional IRAs is 0 because she didn't have any carryover basis, right? Remember, this is her first IRA, so she doesn't have an existing traditional IRA that already had basis in the account. So $2,100 is the IRA basis for her going into next year. And so this is going to be really important tracking from year to year, because once she starts taking distributions from this traditional IRA, she's going to want to know what her basis is, because that's going to help reduce the amount that's considered a taxable distribution from a traditional IRA. All right, so that covers it for this example. Pretty straightforward, simple example. These certainly can get much more complicated, but this one we try to keep it pretty easy. So as always, I appreciate you watching, and I look forward to seeing you again on the next video. Thank you.